Zomato might have, taken some loan, but let's see. It is 0.05. Zomato is not, because it's not a very capital intensive industry as such, okay. So it doesn't require so much of capital for making, factories and all. So if you look at even, their interest coverage ratio is 7.45, which is quite good, okay. And if you look at, the borrowing, which is only 1100, very small amount, because it's just a new company, not a very old one, okay. So interest rates can affect basically the company's fortunes going ahead. So that's why they need to manage. So now coming back to the same question, why do companies need interest rate risk management? Regulatory and reporting. Now most of the companies which are listed in India, they are supposed to make a policy how they are going to manage various kinds of risk they are going to face. It's a part of the corporate governance norms in India. So they have a listing agreement with the National Stock Exchange as well as Bombay Stock Exchange, and they have to appoint a committee which is called the Risk Management Committee. So they are going to bring a report on that. So every annual report will contain kind of a report how they are dealing with and how they are managing. So you can just go through those reports and just read that part so that you know how the companies are doing it. So I'll going to take you through some of the reports or some case studies today. So listed companies must disclose risk management practices, listing obligations and disclosure requirements. So this is called, there is a rule called LODR, which is the listing requirements of the listed companies in India, which is called LODR, and which is given by SEBI. So then, so valuation impact. Now companies' value can go down. That means the share price can fall if the companies don't manage their interest rate. If the interest rate goes up, what happens? The cost of borrowing goes up. If the cost of borrowing goes up, then the value of the company goes down. How does it happen? Anyone? If the interest rate goes up, how it affects the valuation of a company?
So their borrowings will increase. I mean, the interest they have to pay on their borrowings will be higher. Just not because of the principal amount, but because of the interest that they have to pay.
Okay. Anyone else? What you're saying is okay. There's no problem. Increasing. Yeah. Okay. Anybody else? Because I'm just looking for one answer which matches with what I'm going to tell. Okay. But all you're saying is okay. They're right.
So in the end, when we calculate the PAT, interest will increase from the P&L.
Yeah. Okay. So now I think maybe that you have studied and you are not able to remember. There is something called WACC. WACC. कभी पढ़ा आपने? This is called the weighted average cost of capital of the company. Weighted average cost of the company. Company borrows money. Okay. So it will be, the equity. It raises money through equity, and it raises money through debt. And both have a cost for the company, isn't it? Now, suppose assuming there is a mechanism through which we can calculate what is the cost of equity, but suppose it's not implicit, okay? It has to be, it's not explicit, but we need to find some mechanism to calculate, because when you invest in a company, you expect at least a 15% return, isn't it? Agar 15% se kam return hai, you're not going to put money into the equity, into that company. If a company is earning just 5%, you better put money in a fixed deposit. So it gives you some kind of a premium over the fixed deposit, so that it can induce you to invest in that company. So it can be a 15%, 16%, 17%, can be even 20%. Okay. So most of the companies in India would be around 15%. That would be the expectation of the shareholders. At least 15% to kama ke do. So we can assume, without going into the formulas, calculations, and what we can do always that, but let's assume 15% is the. Now debt, suppose the company is paying 10% interest. Assuming 10%, I have rounded off, it can be 9 or 8, and they get a benefit also of tax. Okay. Suppose the tax is 30%. So actually cost is 7% to the company, because interest is tax deductible. So interest hota hai, that reduces the company's income, and company has to pay lower tax, isn't it? So whatever is the tax rate for the company, so you just do 1 minus T, that means 7% will be the cost to the company. Even if they are paying 10% to the bank, only from their pocket 7% is going, 30% is being financed by the government by way of reducing their tax burden. Okay, so which means if the company is putting 50% here and 50% here, so this means this is 7.5% and this is 3.5%. So WACC of the company is what? 11%. So the company's WACC would be 11%. So this is the cost of capital of the company. Fine. You can always, depending upon the ratio of debt and equity, you can always change your WACC. That means cost of doing your business. Suppose the company which is heavily relying on debt, suppose we say 80% here and we say 20, the WACC is going to go up. Isn't the weighted average cost of the capital of the company is going to go up? The company is going to have to service more in form of paying a lot of money through interest payments. Okay, so company can always change the capital structure and can effectively cause a change in the weighted average cost of capital. So this is the money which the company is paying, okay, in terms for financing the projects. जो कंपनी फाइनेंस करती है यही तो पैसा उसका लग रहा है ना, यही तो कॉस्ट लग रही है. Is it okay? Fine. Now what's happened is that when we calculate the valuation of the company, I don't know whether you have studied or not. So there is a mechanism through which there are a couple of mechanisms, but this is the most relevant mechanism through which we calculate. The most trusted, but it requires a lot of calculations. That what you do is that you calculate what will be the cash company is going to generate, or how much income it is going to generate over the years. But it is not the income, because income is an accrual concept. It doesn't mean equivalent to the cash, because some customers might have not paid, okay, and that has been reflected in the profit. So whatever cash the company is getting, that is more important. So you calculate how much cash the company is going to generate. So you calculate cash flow. Cash flow for every year. You project the cash flows of the company. If you want to know what should be the price of Reliance or any company in India, so you make a projection of cash flow of the company. All the analysts will do how much cash the company is going to generate.
That is determined by reserves.
Anji?
From that sheet, the screener sheet that you were showing, that is determined by the reserves, right? Cash flow is determined by
No, cash flow is basically it will start with income or maybe PAT, and there will be some plus minus, okay, like suppose increase in working capital, which means increase in receivables. So there is a calculation formula. Suppose the company's receivables have gone up, so that means customers have not paid. So company has reported say 100 rupees profit, so the debtors have gone up by say 10, so that means it is going to reduce, the cash flow will be only 90. It's a very simplified myth. There's a long formula for that, just to make it very simple. So the cash will be only 90. So it starts with the profit of the company, then you do some adjustments with the profit and make it into cash flow. Okay, आपने cash flow निकाल दिया company का. Okay, that you can always do that, very simple, and you don't have to do it. You can rely on somebody else's work. You can just check on the internet. You will find how much cash the company is going to generate. You project the cash flows of the company. Okay, for the foreseeable future. क्या अगले साल कितना होगा, उसके अगले साल कितना होगा. For 5 or 7 years, you can always do that. All the analysts, they know that 5 years they can always calculate. Even the management does it. Okay, so they can rely on the management estimates. Fine. Now what you do is you discount those cash flows. Okay, not just this 5 years, the cash flows till the company is going to last. It's an infinite period. So there is yet another mechanism through which you can calculate all the cash flows the company is going to generate till the company lasts, which is an infinite period. Okay, there's a formula for that. So then you discount those cash flows, calculate the present value of those cash flows. Okay, so that is the total value of the company today. आज की value of the company क्या होगी? Whatever the present value of all the cash flows which the company is going to generate during its lifetime, you calculate what should be the present value of that. How you do that? By discounting those cash flows using WACC. So that means you take the cash flow and divide it by the WACC. Okay, fine. So if the WACC is 10%, you may get one calculation. If the WACC is 15%, that means the present value is going to decrease, isn't it? Suppose यहाँ हम 10% रखें, cash flow divided by 10%, so value is say 100. So if I take 20, then the value will become 50, like this. Simple calculation. So the more the weighted average cost of capital, the value of the company is going to fall. Anji? Lower the present value of the cash flows. Like just to give an example, simple example. Suppose you have a property of 1 crore. it is going to give you a rent of say 10 lakhs per annum. It is giving you a 10 lakh rupees rental, and you own a property which is, you don't know what the value of the property, and you want to derive what is should be the value. Somebody comes and say, I want to buy this property. So how are you going to derive the value? So how much you're getting? 10 lakhs. So every year you're going to get 10 lakhs. So it may increase also. So you can apply some multiplier that will keep increasing by 5% every year. Okay. Then you divide it by the percentage. Okay. Suppose you are going to, if you get the money, you're going to deposit in some investment or a fixed deposit, you're going to get 10% return. Okay. If you are going to part of the property, you're going to get cash. You're not going to keep it in your bank or in your house. You're going to again invest. So you say that I'm going to invest I have an opportunity where I can invest at 10%. Okay. So you calculate the cash flow, all the cash flows, and discount those cash flows by the rate of interest at which you are going to deploy that money. You will get the value of the property. Suppose the value comes to 1 crore. So that means the real value of the property is 1 crore. Because 1 crore, suppose it's a property 1 crore, okay, and you apply 10% rate of interest. So it is going to give you exactly 10 lakh rupees with you so that you can part with. You say, I don't want to remain in property. I want to remain in an investment which gives me 1 lakh, which is much better than holding a property. So आपने 1 crore value निकाली, उसको 10% deploy कर दिया. Every year how much you are getting? 10 lakhs, which is equivalent to what you are getting with holding the property. So you can shift from one property to another form of investment by discounting all the cash which the asset is going to generate, and that will be the value of the company or the value of the asset. So this way the valuation is done for anything in the world. So this is called the DCF method, which is called the discounted cash flow method, for where you require two things: the cash, how much the property or asset is going to generate, and what is your cost of capital. Okay, fine. Hanji? Usually ऐसा होता है, for the 5-10 years you can calculate, you can visualize, how much cash it is going to generate. Fine. In case of property, you can always say it will keep increasing by 5%. Okay, keep increasing till infinity. And there is a mechanism, there is a formula which is called the terminal value, and you use that formula to calculate. You can just Google and find out. There is a formula for calculating that. This is a valuation, अलग exercise है, अलग subject है, अलग topic है. It's an MBA course, a separate thing. I don't know whether you have done it or not, or maybe it is not there in your course. Okay. हाँ, बहुत अच्छी चीज़ है. देखो क्या होता है, हर कंपनी की वैक डिफरेंट होती है. The company becomes riskier and riskier. The WACC will go up, isn't it? जो कंपनी ज़्यादा रिस्की होगी उसका WACC भी ज़्यादा होगा, और जितना ज़्यादा WACC होगा उसकी वैल्यू कम हो जाएगी, because you are going to discount at a 20% as against 10%. Suppose the Reliance is having a cost of capital of 10%, it will throw a valuation. If the Reliance cost of capital goes to 20%, the value will become half of the company, because you are discounting at 20% whatever cash flows the company is going to generate against 10%. So company becomes riskier and riskier as the company borrows money, and the WACC also goes up. Even it affects equity also, because the shareholders will give you only money only now because they perceive the company has become risky. So this 20% cost of capital, what I'm talking about, will go to 20%. Fine. The new equity shareholders who are going to again give money to company, they will say that if we expect 20% return, then only we'll give you, not below 20. Earlier they were ready to give at 15%. If the company is not earning 20, they are not going to finance. They are not going to get any money from the equity shareholders, because the company's debt burden has become so high that the equity also becomes costlier. As the equity and debt becomes costlier, the WACC goes up, the company valuation drops, isn't it? Because you are going to discount all the cash flows that the company is going to generate with the help of a WACC, which is going to throw the value of the company. Now, how do the equity researchers do that? They calculate the value of the company, total value, and then they divide by the number of shares which the company has issued. Per share value आ जाती है. Now they say that Reliance is today should be valued at 3,000 rupees, or say 2,000 rupees. And what is the value today? 1,300. So they say that Reliance is going to go to 2,000 rupees, because as per DCF valuation, they have found that the real value of Reliance is say 1,600, for example. 2,000 is very high at the moment, But suppose they calculate 1600. So whenever you see the like JP Morgan and other companies giving you a target of Reliance or any company in India, they are using a mechanism which is called DCF method, okay, which is highly, it requires a lot of, calculations, and everybody, two people calculating it will get different numbers. Anybody calculating, management doing some calculations, researchers doing. So what we do, we look out, say for 20 researchers who have calculated the value of the company, we make an average and say this, ye to hoga hi hoga, because average sanitize the data. Okay, like what we do, we just exclude the outliers. We take all the people who are in that within a range and divide by the number of researchers. We calculate the value of the company. Okay, is that okay? So, so every company is trying to calculate, all the finance companies, they're trying to calculate what should be the value of every company in India which is listed, and they'll give you a target, and then they say buy or sell or hold, depending upon their calculations. Okay, so valuation impact. So let's come back to this. For companies dependent on long-term projects or those with high leverage, changes in the interest rates can affect their valuation significantly. Okay. So hedging market exposure. Managing interest rate risk through tools like swaps or options help stabilize earnings and reduce market exposure. So that means we should do some kind of hedging to bring down the interest cost. So we are going to learn that today. So before that, the valuation impact, a small case study. So there was a company called IIFT. Have you heard of this company? Which collapsed about 5 or 7 years back. So this is infrastructure leasing and financial services, which faced a significant valuation and financial crisis influenced by rising interest rates and high leverage. So if you look at the share price, it came down from the share was somewhere around 25, and then it come to it came down from 25 to just 3 rupees 59 paisa. Okay, fine. It was just because they were exposed to such things. You can just go through this. They were having a loan of 91,000 crores in their balance sheet at the time when the started affecting their valuations. And so I'm skipping this a long one. So just read from here. Liquidity crunch. Rising interest rates coincided with reduced cash flows from infrastructure projects due to delayed and operational. What they were doing, they were taking the money and giving to various projects. They were lending money to the projects which were long-term projects. Okay, those projects were not generating enough revenue and giving back the money to IIFT in time, so they were having some problem. Okay, this created a liquidity crisis, forcing IIFT to default in multiple loans, for further eroding stakeholders' confidence. So since their main motive was to finance the big projects, like the road projects, metro projects. Of course, metro is the government one, but all the private projects they were financing, and those private players were unable to repay the money in time, and this created a liquidity crisis. So they had a credit downgrade. As the company struggled with cash flows issues, rating agencies downgraded. The downgrades increase the cost of refinancing debt. So that means when the downgrade happens, the further increasing of interest cost to the company, because whenever they take a fresh loan to repay the old loan, the new loan will carry a higher interest cost. Outcome, the valuation collapse. The company's valuation plummet as the investors discounted future earnings due to higher risk and interest costs. Okay. In 2018, this company valuation eroded significantly, leading to a systematic impact on India's financial sector. So this was one of the biggest company in India in terms of how they are financing their projects. So the government intervention came. The crisis led to the government takeover of this company in 2018 to prevent systemic risk to the economy. So it was posing a risk to the economy. So government took over. The company's assets were monetized, but the valuation dropped far below its earlier estimates due to rising cost and reduced projected feasibility. So that means the key takeaways were the leverage. Companies with high leverage are particularly vulnerable to rising interest rates, as even minor rate increases amplify the debt service cost. DCF valuations, the rising interest rate increases the WACC, reducing the present value of the future cash flows, impacting the long-term valuation of the company. So because of that, the company's cost of capital gone up, and when they discount after discounting those cash flows, the valuation was looking very small, and they collapsed. Hedging strategies and prudent debt management can mitigate the impact of interest rate volatility on valuation. That is what we are going to understand today, how the companies can manage their risk and affect an event like this. Now, again coming back to the same question, which companies need interest rate risk management? Financial institutions, okay, like banks, because they are dealing only in interest, they are paying interest, they are collecting interest, so they are vulnerable to all these shocks. Real estate and infrastructure companies, like the company which we talked about. The corporation with high leverage, like many companies, like even Tata Motors have good leverage, Reliance has a good leverage, but in terms of debt to equity, they are very comfortable, interest coverage ratio is very good. Exporters and importers, because the interest rates impact the foreign currency, because foreign currency is dependent on the interest rate of the two countries. The utilities and energy companies, so they are heavy consumer credit driven companies, because their products are based on interest going up or down. If the interest comes down, people make more houses, people buy a lot of cars and other things. So the consumer credit driven companies require a lot of interest rate management. Then I've just given what should they do, but I'm just skipping that at the moment. Okay, so we come to the main chapter, which is interest rate derivatives. Okay, because that was just the theoretical part, and now we are going to say what are the various kinds of interest rate derivatives, and there are many. But we are going to just focus on a couple of them only, because the course says that we have to do only interest rate swaps. Okay, we are going to talk about interest rate derivatives are financial instrument whose value is derived from movement in interest rates, because it's the interest rate which can affect the value of the derivatives. They are widely used by financial institutions, corporations and investors to manage interest rate risk or speculate on future interest rate movements. Okay, so hedging interest rate risk. Traditional methods. These methods can further be classified into following category: asset and liability management. So you manage your asset and liability. Usually all the financial institutions or companies or bank, they manage their asset and liability, because they have liabilities in terms of servicing the fixed deposits, saving accounts, that's the liability of the bank, and the assets are the loans given as housing loans, corporate loans. So they have assets which generate interest revenue, and their liabilities which involve payment to cash outflow from the company. So both should be properly managed, because they have there is a mismatch in the durations, because the loans are given for 10, 20, 30 years, whereas the deposits are there only for 1 year, 2 years, 3 years, and interest rate keep fluctuation. It can cause an impact on their profitability. Okay, so asset and liability management, so we're going to talk about that. Then there is a forward rate agreement. Okay, where my slide contains the material on that, so you can just go through. I'm going to skip that. What we are going to understand is interest rate futures, interest rate options, and interest rate swaps. Okay, so the more modern methods we are going to talk about, which are affecting most of the companies. Asset liability management only concerned with the banks. Okay, FRAs anybody can take, even corporates can take. So financial institutions ensure its loan portfolio is balanced between fixed rate and variable rate products. That means they give loans both in terms of fixed interest rate as well as variable. So when they give loans at both, so even if the interest rate goes up and down, they are not going to be so much impacted. If they are given the loan on variable, so that means if the interest rate goes up, they are going to get more interest from the person who has borrowed the money from them. Okay, because some borrowers, they always prefer a fixed rate, so they just keep the interest rate a little higher so that they don't lose out. I was telling you that I took a loan way back in 2006 when the interest rate was the lowest. I got it at 6%. Okay, for 15 years, just closed down last year only. I just finished repaying that loan. So for the 15 years long, I paid just 6% loan, 6% rate of interest, fixed rate. Whereas floating rate was available at say 5.5% that time. But I choose to pay more, 0.5%, because though I was not that much, I didn't have idea that the interest rates are going to, go up. But some kind of a thing came in mind that I should pay more and let it be say 6%. And it happened like this: the interest rate on housing loan went up as high as 11%. And I was still paying 6%. Most of the people who borrowed along with me, there were about 15 people who borrowed in the company. They were paying 11, 12%. Then they all called me up and said, you did a great job that you are still paying 11%. I also checked with the Standard Chartered whether they are charging 6%. They said your loan is for full 15 years, it is 6%. It's not going to change, because that is a term you have agreed with the bank. Even if the interest rate goes to 20%, I'm going to pay at 6%. So I continuously paid at 6%. And thereafter, the banks realized that this can cause problem because if the interest rate goes up and their fixed deposit cost goes up and the interest they are paying only getting only 6%, that will adversely impact their profitability. Now what they do is, anybody who comes asks for a fixed rate of interest, they say, okay, we'll give you higher, plus after every 3 years it will be again reset. After every 3 years it is reset. It is never given for 15 years long for a same kind of interest. So now they become wiser. So they are giving fixed only, which is reset after every 3 years. So that only you can enjoy up to 3 years at the most. Okay. So so if you look at a balance sheet of a bank, it looks like this. So just focus on deposits. How much deposits they have? 26,40,000 crores. This is State Bank of India. And look at the liability side of the bank. So first is capital, then reserve and surpluses, then minority interest, then deposits, and then borrowings. So this is the money which the bank has generated. This is their liabilities. That means the bank has have deposits, saving accounts, but not for 26,40,000 crores. And then it been rising from 2016. It was 23,92,000, and then they borrow also money. Okay, because they need more money to lend. So either they get it from the depositors or they get it in form of borrowings from the various institutions or abroad. So how much is the total borrowing? If you look at deposit and borrowing, it's about 29 lakh crores. And look at now the loans. The loans are given on the bottom with the assets of the company. So which is net advances. So 18 lakh crores plus the investments. So either the money which has been collected in form of deposits or borrowings, they are deploying it back into the business and earning interest on that. Their main job is to give loans. So that is around 18 crores, but they can't lend all the money as per the RBI norms and Basel norms prevailing in international. So the bank's balance sheet has to be healthier. So some money needs to be put in investments. So they have investments of 11 crores. So you look at both, they are almost like matching, 29 crores of liabilities and 29 crores of assets. And some are in form of investments, and major investments are in form of government securities. So they have to put back the money in government G-Secs. Okay, the government which is paying around 7% depending on the interest rates, coupon rates at which they are giving. So it is 11 crore 28 lakhs. So they need to manage these two in such a way that they are able to generate profits all the time. Okay, so this is called asset liability management, where I have written how they do that at the bottom here. You can go through what they do more in detail. Okay. So now we come to the forward rate agreement. I am going to skip. You can just go through yourself. Maybe if time permits, I'll just take you through. But first, we'll cover the course. So only what we are doing. The slide is very long, so you just focus on what I am teaching. Others you can skip for the exam. So it is interest rate swaps, which is the major chapter, which you might have done in your some course, isn't it? Correct? Huh? IIFT. Okay. So I'm just going to give a different perspective to it a little bit, because every person has a different way of teaching. So I'm just going to tell you that. An interest rate swap is a contract